Hello, Sector Watchers. Welcome to the show. This is the 103rd episode of Sector Spotlight on Tuesday, the 2nd of November, and recording it on Monday, the 1st. My name is Julius de Kempenaer, and I'm presenting to you from Amsterdam in the Netherlands. If you want to reach out, please use any of the handles on the screen. For those of you who have requested the seasonality spreadsheet after the last show, I didn't forget you. I just have a little bit of a backlog, but just be patient. It will come your way in the next week, I presume. Today is the first Tuesday of the month, and that means that we're going to look at monthly charts. Obviously, we're going to start with a quick look at the current rotations in asset classes and sectors. Maybe bring in some weekly price charts to align things. But the main focus of this show will be to take a look at the monthly developments on the price charts for asset classes and sectors and see if we can find a common theme and make up our minds about what the market's going to do in the next few months. Let's kick off with the current state of rotations for asset classes. On the left-hand side, we have the weekly RRG, and on the right-hand side, we have the daily version. If we look at the last week performance, then, and I ranked it on just outright performance, we can see that the stock market, so the iShares S&P Total US Stock Market ETF, was the biggest performer with 1.1%, followed by the investment grade corporate bond ETF with 0.9%. The benchmark VBI-NX came in at 0.9%. That means that all the other asset classes on this list, in this universe, were below VBI-NX. And if we go over them, then we see fixed income stuff, so government bonds, high yield, on the left-hand side, below VBI-NX. And we also see commodities and real estate at the bottom of the list. If we look at the position on the RRG, then V&Q and ITOT are in the top right quadrant. So they are still the leading sectors, which means a risk-on perspective. ITOT and V&Q, both I think the most predominant risk-on asset classes in this universe. They lost a little bit of momentum on this daily RRG last week. Stock market did pretty well. V&Q did not so well, although it didn't lose any money. It was just flat. And you see that these fixed income complex, including the US dollars on the left-hand side, in lagging, but started to pick up at the end. And you see both commodity ETFs inside weakening and moving towards lagging. Minus 0.3, minus 0.7, but I think in the bigger scheme of things, with the turnaround that's going on in commodities, or the uptrend that's already underway in commodities, that's not a big deal. That's not a big thing, especially not if you look at the RRG on the left-hand side, where both commodity ETFs are powering into the leading quadrant. These are really the strongest assets on this RRG, followed by ITOT and V&Q. And what we see here is interesting, because ITOT now, it's got a very short tail, and we know that when it's got a short tail, it's a stable trend. And what we really like is when it's inside weakening and starting to curl back up and move towards the leading quadrant. And that's now underway. That now seems to be happening on the weekly RRG for the stock market. And V&Q is following. It's still moving lower on the RS ratio scale, but it's got some time, so it could still curl back up and move back into the leading quadrant, which would make ITOT and V&Q the leading asset classes, which they in a way still are, because they are the highest readings on the RS ratio. But when they move back up, when they got that nice curl back up and start to move at an RRG heading between 0 and 90 degrees, that's really what you want to see to have a really confirmed relative uptrend versus VBI-NX. On the other side, we see GOV rolling over, and if I highlight that, you can really see that rotation of government bonds through improving, not being able to make it to leading, and then rolling over and starting to go back to lagging. High yield still holding up, but you can see that it is, the distances between the observations are getting smaller, so that's also an indication of a loss of momentum. I don't think that that's going to make it all the way into the leading quadrant, to be honest. The US dollar lost a little bit here on that last week, as you can see here, and that is followed. That the reason why that is happening is because we had that little dip that the US dollar had to go through on the daily RRG. So when this rotation continues and the US dollar moves into improving and maybe then back to leading, we will definitely see this still starting to pick up and move back to the leading quadrant again. If we quickly take a look at one or two charts out of this list, then I think the US dollar one is interesting and important actually, because we have this big break still valid. Last week before, we had this dip, but it stopped at the former breakout level, so around 93.2, and it's now bouncing back up. So in terms of the dollar index, I think we should be looking for a break beyond 94.6, rounded off. Anything above 95 would be really good for the US dollar, and you can see that coming back when you look at the euro dollar chart. We had that. This is that big bounce back. By the way, this is flipped because it's euro and dollars, so a decline here is a strength for the US dollar and weakness for the euro. And you can see that we had that blip back to 116.90, which is, here 170 something, 166. That is that breakout level that we tested now as resistance. It's also nicely aligning with that falling resistance line, so it gives a little bit extra confirmation. And then at the end of the last Friday, we got that big dip back, and we're now back at 156, pushing lower. So if we drop below 115, that would be a real new trigger for more US dollar strength and euro weakness. We quickly look at the government bond chart. You see that we had that hiccup here. It's now nicely moving lower, so yields are being pushed higher, and I'm watching this previous low, which is just above the 26 US dollar in GOV level. And we will see probably, we don't have IEF here. The ITOT GOV chart, that's a really interesting one, because as you know, we have been quite patient with the relationship between stocks and bonds. It was for a while more leaning towards the bond section based on that big divergence between this ratio and the RRG. That divergence is now broken, so it's negated. That's off the table. We're now back up. The RSI is back above 70. That divergence is gone. And you can see that the ratio is now actually breaking out at the top of that channel that we could draw here. So we had that little pause inside that channel. We never had the real dip, and now we're breaking out to the upside. So that's actually a pretty strong sign for the relationship of stocks versus bonds. So in terms of offense defense, this is definitely pointing towards an offensive stance and a preference for stocks over bonds in coming weeks. Moving on to the sectors, we have the weekly RRG on the left and the daily version on the right. Market is now open. It's November the 1st, so it's Monday. So I actually have this on 6 trading days, so it includes the entire last week, including market action until it is 6:30, so that's 12:30 p.m. In New York when the market is trading. So here are the longer term tails, and you can see the longer term trends. I think if you look at the rotation of last week, we can see that the discretionary sector is clear winner with a gain of 5.5%. Technology did pretty well with 1.5%, and then you see that when a pretty heavy sector like discretionary and also technology, they're outperforming the S&P 500, that the rest of the sector is actually underperforming the S&P 500. So looking at this, discretionary technology in the green. If you look at the tail for discretionary, that's still strong. You've got real estate technology inside leading, but they are losing a little bit of momentum. Discretionary is not. You see industrials, materials rotating back. You see healthcare and utilities picking up here in the improving quadrant on the daily. Staples and communication services in lagging but picking up, and you see energy making a wide swing through the weakening quadrant, and it's now actually decreasing its loss in value on the momentum axis. So we'll have to see whether that continues into lagging or whether it is able to actually pull back up and start moving towards leading again. Look at the weekly tails, and obviously the long tail on energy is still there, still showing a very strong relative trend, so that's a good thing. We have discretionary, I think, being probably the most promising and strongest sector on a relative basis. You see it almost a straight line into the leading quadrant. You see the distances on the tail are getting bigger. That's another confirmation of strong momentum, strength behind the move. Financials are okay, but you can see that they are rolling over, and that is because of this loss of momentum here over the last 6 days, maybe even a little bit longer, that you see a loss of momentum in financials. Discretionary energy, really the strength, and then you see technology, which is still the highest reading on the RS ratio scale, which makes it, in that terms, the strongest sector still. It's just traveling at a negative heading, which makes it, which signs that it's a pause in the relative uptrend, but it still has enough time and room before it hits 100 on the RS ratio scale. So if this is really still the strongest sector, then I expect it to curl back up and come back into the leading quadrant in the next couple of weeks when this is happening. And what you see here, and I'm going to blow it up a little bit, is that where for discretionary the distances on the tail were getting bigger, you can see that here for technology they're actually getting smaller. And when the tail is at a negative heading, when these distances are getting smaller, that's actually a good sign, because that's often the prelude to the tail curling back up. So we're going to keep an eye on that in coming weeks. We're going to take a look at a few price charts out of that universe here. Then let's begin with the technology sector. Because you see that it's in that pause, it's rolling over in weakening, and that's because it's still hitting against that ceiling of relative strength resistance that's in play now for over a year, and that is now causing, because we had that run up here, so that was picked up by the RRG lines, but now the last few weeks we're already going sideways. And we really need for this tail to curl back up and come into leading again and make technology the leading sector. We do need to break above that ceiling in the raw relative strength line. The price is already trading above its previous high, so that's a good thing, although it's not really massively, but we are above it, so that's good. We overcome that resistance. What we're looking for now is a break of resistance in that relative strength line to bring that green RS momentum line back above 100, that causing that tail on the RRG to curl back up. The discretionary sector obviously super strong, and you can see that back here. You saw that sort of, it looked like a wedge, but it never executed. And then you go the other way and you got that explosion to the upside. You see it here in relative strength. That's very good. That was already here. We had the RS momentum above, so that was improving. And now the RS ratio line is coming back above 100 as well, and that's causing the tail of XLY to move into the leading quadrant. So maybe a little bit of a setback in coming weeks, because this has gone very, very fast, very, very rapidly. But no doubt about it that the trend here, both in price and in relative strength, is upward. Let's look at the third sector in the green leading quadrant. That's financials. You see here that it's also running into overhead resistance on relative strength. The RRG lines are leveling off. The price chart breaking to new highs. That's a good thing. That divergence that's still on the chart when I put it out a couple of shows ago is now negated, that's gone. So there is now new room for price to improve again. So that's a good thing. And then let's have a look, because on my last blog article I wrote about offensive and defensive, and I brought beta values back into, and I speak about classifications of offensive and defensive sectors. I'm not going to do that right now, but the main takeaway for me at this point in time in terms of rotation is that the clear defensive sectors, and these are utilities, staples, and healthcare, they are all inside the lagging quadrant, and they are all at a negative RRG heading. So if you do utilities, that is clearly rotating negatively. This is healthcare, clearly rotating negatively, and here is staples, clearly rotating negatively and going back into, this is history, so and now going back into lagging again. And when these three very defensive sectors are underperforming the general market, that is very often a sign for underlying strength for the market as a whole, because it means that people are allocating more money to offensive sectors. We're going for a quick break right now, and after that we're going to talk about monthly charts. And then we start with a look at the completed monthly charts for October. Kick off with the chart of ITOT, the total US stock market ETF, and where we had a situation where we had a pretty nasty bar or candle, depending on what you're looking at, last month. This month is actually the reverse, so we actually dipped a little bit lower. You can see here the opening and then a little bit lower, and then we had a very strong recovery through the end of the month that actually pushed the stock market A to new highs and B to a new closing high in terms of ITOT, which is pretty strong. If we look at downward risk, then obviously in a way it's higher now because the market rose, but we can now start to bring in new levels, and we will see that throughout the monthly charts that we'll be watching, is that a lot of these support levels have now pushed up. So overall, the downside risk has now decreased a little bit. So for here, for stocks, for this index, 12 to 24%, whereas the 24 is now starting to look a little bit big, but it's really the last real high that acts as support. And then there is one here where two monthly highs are aligning, but there's not really, I'd like to see a high with two lower highs on either side to actually call it a peak or a trough, vice versa. That's not happened yet, but things are improving, that's for sure. If you look at the chart of the S&P, you see the same. And here I've drawn the support level. It's a bit of the cluster of highs that we have here and the low of this month. And it's a bit risky because we cannot, as I just explained, it's not really a low yet, because then we would need to see November with a low of the month to be higher than the low of October. Obviously we can't say that yet, but this one has now moved up. So here, this is a situation where you have a real high with two lower highs on either side. So that is 350, 360, round of 360. I'll take it as like between 7, which is the shorter term, the near term support, and around 20 in downside support. Again, here, levels are being pushed higher. If we quickly go over Gold, that's an interesting one. Here you see very clearly that the lower high is in place and we're moving lower, and it becomes even more clear when you look at the IEF chart. That's actually approaching the previous low, that's on 1270. If that breaks, then we have a clear series of lower highs and lower lows in place for 7 to 10 year treasury bonds, which means that we have a downtrend in treasury bonds and pushing yields higher. So that's quite an interesting development that we see developing now. Look at corporate bonds. They actually have their lower high put into place. It's working there. We can look at high yield. That has not been able to get out of that trading range. With this, you see it rolling over. So 1, 2, 3, 4 monthly highs around the same level, just below that overhead resistance level. And now we see the market moving lower there. And then V&Q, real estate is an interesting market. It's a reverse. We broke higher. We had a very weak. It's in line with the stock market. But here you see that this old resistance level is now acting as support, which is actually a pretty good sign, and it underscores the strength of the real estate market, of the stock market, the real estate sector. So here we have commodities. DJP now really approaching that major overhead resistance level that's coming from the 2008 low. Once that was broken, it came back as a resistance in 2015, and it's going to be very interesting to see how this month will play out. So we we peaked above it last month and we dropped back, and now we really need to push higher, or maybe we're going to see a little bit of a rollover before we push higher. But the trend here is very clearly intact. US dollar, we already discussed it before the break. I think that double bottom here is in place. We have already seen this former resistance, now support level being tested. If we can take out, like, I don't know, 95, that will definitely be signaling further strength. Next level to watch is this old trend line that's going to be acting as resistance, and that's around 96.5, 97, I think. And then let me bring up this is the one that's really interesting, ITOT versus GOFT. This is a very nice move, or the equivalent of SPY versus IAF, similar chart. Really pushing higher, really underscoring the strength of stocks over the bond market right now. For the sectors, I am quickly going to run you through the 11 monthly charts for all the S&P sectors, and then wrap it up in the table that we've been maintaining here on the show for the last few months. So I'm not going to read out all the downside risk levels, but I hope that you can see that they in general have shifted higher, meaning that the downside risk has become less for most sectors. So that's the overall picture that we're looking at. If we start with communication services, then this is definitely a sector that is not at all-time highs yet, but the uptrend is still there, and we're working on resistance. The consumer discretionary sector, I think, is one of the strongest sectors at the moment, and that's displayed with that really strong bar that we saw in October, really pushing higher, pretty much above all levels that we've seen so far. If you look at staples, a little bit less. The ratio of discretionary versus staples is also very much in favor of discretionary at the moment. And you see that back here in the staples chart. It's against the top of that trend channel. We're holding up above that former resistance, now support, so that's a good thing. The uptrend is still there. The pace is just a lot less. Now we have the energy sector, which is now definitely in an uptrend on the monthly chart. We have the high, low, higher high, and now a higher low, and we're taking out that previous high. So we're now technically in an uptrend in the energy sector. We do need to see what's going to happen when it's bouncing against that falling resistance line that runs over the highs that are in place since 2015. But definitely for the next few months, energy sector is looking pretty strong actually. Now we have financials, which have definitely continued their uptrend. So we have the high, low, and now we've taken out the previous high, pushing to new highs. This is a sector where the downside risk has definitely decreased. You can see here the previous 2 monthly highs, that's only 3% away. That's your first support level, and then the next one is about 13. It was here, which was much more downside risk. So the fact that we're now breaking above to new highs with these higher lows in place definitely decreases the downside risk for most sectors. Healthcare, another sector that's doing really well right now. It was already in a strong move and a strong uptrend. Last month was characterized by the dip lower, so we have 3 months with prices going lower, and then at the end of last month we rallied. And again, it's too early to call this a support level, so the next level here is around 10% lower and then 12. But this chart, especially the fact that we're above that old channel and holding up and on the way to taking out that all-time high around 1600, is definitely in favor of the healthcare sector. And then we have industrials that are sort of moving sideways. Technically, this is a downtrend because we have a high, we have a low, we have a lower high, and last month, so not in October but in September, we broke below our previous low, and in October we've not been able to take out that most recent high. But I think that everybody agrees that this is sort of a consolidation pattern, and when the industrial sector will take out this resistance area, let's say it's around 900, then this is really going to be one of the better sectors in the universe, I think. Then we have information technology, which is just back in its old swing, pushing to new highs, new closing highs. And we see the materials sector is not in a downtrend because it held at this former support level. And I'm actually waiting for this to move higher and to take out that 560. If you remember on the RRG, it's actually one of the sectors that is now pushing into the improving quadrant and really picking up. And then we have the real estate sector. We've already seen V&Q, so a similar chart here. Pretty strong chart on its way to new highs. And then we have utilities here that are, well, they're in an uptrend, but they're moving sideways. There's a lot of overhead resistance here waiting for yields to break. But again, it's in line with the defensive character of this sector, and all the cyclical sectors doing much better right now, as I discussed before the break when we talked about the RRGs. If we look at the table wrapping up everything that we've seen, we see that every sector had a positive performance over the last month. S&P up 6.9, discretionary and energy even more than 10%, so that's really good. Not all sectors are making new highs and new closing highs. Actually, it's only discretionary, financials and information technology, and on the back of that the S&P 500, that are making new all-time highs and new closing highs. For the other sectors, they are not there yet. Could come in the next few months, but for this month they're not there yet. Almost all sectors are in an uptrend. The only one, and we discussed it, is industrials, and even that is, it's very technical, say lower highs, lower lows, so it's not in an uptrend. But the chart is still looking very good. So when we wrap that up, then we have 51% of the market capitalization moving to new highs, 51% to new closing highs, 91% of the market capitalization of the S&P 500 is in an uptrend, and the downside risk, as you can see here, is now single digit for the most sectors, where it was previously almost always starting with 10, 12, 13, and then up to the 20 and even 30%. So I think there's definitely an improvement going on. Ladies and gentlemen, this wraps up Sector Spotlight for this week. I hope you enjoyed the show. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern here on StockCharts television. And I hope to see you back next week, same time, same place. Oh, and if you want to give us a like, then please do so below, or if you have any comment, please let us know.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.